QQQ and QQQM look almost identical. They track the same basic idea. They both give exposure to the Nasdaq-100, they both are heavily tied to big growth companies, and they both are popular with investors who want tech-heavy exposure. So why do both exist? And more importantly, if QQQM is cheaper, should you switch from QQQ to QQQM in 2026? That sounds like a simple question, but the answer depends on how you invest. If you are a long-term buy-and-hold investor, QQQM may be the more efficient tool. If you trade actively, use options, or need maximum liquidity, QQQ may still make more sense. So in this video, we are going to break down QQQM versus QQQ, the fee difference, the liquidity difference, the tax issue, the concentration risk, and the practical decision. Because QQQM is not really a different bet. It is mostly a cheaper way to hold the same Nasdaq-100 bet. Let's start with what QQQ and QQQM have in common. Both funds track the Nasdaq-100 index. That index is designed to measure 100 of the largest non-financial companies listed on the Nasdaq. So when you buy QQQ or QQQM, you are not buying the entire U.S. stock market. You are buying a growth-heavy Nasdaq-100 portfolio. That usually means exposure to large technology companies, communication services, consumer discretionary names, and other innovation-focused businesses. This can be attractive because many of the world's most influential companies are inside this type of index. But it also means the portfolio is more concentrated than something like a total market ETF. QQQ and QQQM are not total market ETFs. They are Nasdaq-100 growth-heavy ETFs. And once we understand that the exposure is very similar, the first obvious difference becomes cost. The main difference between QQQ and QQQM is cost. QQQ has an expense ratio of 0.18%. QQQM has an expense ratio of 0.15%. That is a difference of 0.03 percentage points per year. On $10,000, that is roughly $3 per year before considering other factors. So at first, the difference may look tiny, and for a small position, it is not life-changing. But long-term investing is often built on small differences compounding over many years. Lower fees do not guarantee better returns, but when two funds provide very similar exposure, the cheaper version naturally deserves attention, especially for buy-and-hold investors. The fee difference is small each year, but long-term investing is built on small differences compounding. So if QQQM is cheaper, the next question is obvious. Why does QQQ still exist? QQQ still exists because cost is not the only thing investors care about. QQQ is one of the most heavily traded ETFs in the United States. It has deep liquidity, it is heavily used by traders, it is widely used by institutions, it has a very active options market, and it can be useful for short-term positioning, hedging, and tactical strategies. For someone who buys and holds for years, that may not matter much. But for someone trading large positions, using options, or needing very tight execution, liquidity can matter a lot. That is why QQQ and QQQM can both exist. They are similar exposure, but different tools. QQQ is a trading machine. QQQM is the long-term holding tool. And that distinction is the key to the entire decision. So let's make it practical. Who may actually prefer QQQM? QQQM may make more sense for long-term investors, especially investors who want Nasdaq-100 exposure but do not need options, active trading, or maximum intraday liquidity. If you are buying and holding for years, the lower expense ratio can matter more than the trading advantages of QQQ. QQQM may also fit investors who make recurring contributions. For example, someone adding money every month to a long-term portfolio may care more about reducing fee drag than about having the most liquid trading vehicle. The key is that QQQM is not trying to be a completely different investment. It is giving investors a lower-cost way to hold Nasdaq-100 exposure. So if you are buying and holding, the cheaper version deserves attention. But cheaper is not always better for every investor, because there are still situations where QQQ may be the better tool. QQQ may still make sense for active traders. It may also make sense for investors who use option strategies, or for institutions that need maximum liquidity, or for investors using tactical short-term positions. QQQ can also make sense if someone already owns it in a taxable account with large unrealized gains. In that case, selling QQQ just to buy QQQM could trigger taxes, and those taxes might be much larger than the small annual fee savings. That is why the cheapest ETF is not always the best ETF for every job. For long-term new money, QQQM may make more logical. But for trading, options, and taxable positions with big gains, QQQ may still be the right tool. So instead of asking only which one is cheaper, a better question is this: should you actually switch? Whether you should switch from QQQ to QQQM depends on your situation. First, ask where you hold QQQ. Is it inside a retirement account like an IRA? Or is it inside a taxable brokerage account? That difference matters. Inside a tax-advantaged account, switching may be simpler, but inside a taxable account, selling QQQ can trigger capital gains taxes. Next, think about the size of the position. The larger the position, the more the fee difference matters. But also, the larger the position, the more taxes and execution costs may matter. Then ask how you use the ETF. Are you holding long-term, or are you trading? Do you use options? Do you need maximum liquidity? The important point is simple. Do not save 0.03% in fees by creating a bigger tax problem. And even if switching makes sense, there is one risk it does not solve: concentration. Switching from QQQ to QQQM lowers your cost, but it does not lower the main risk of the Nasdaq-100. Both ETFs still have similar exposure. That means both can be heavily influenced by mega-cap growth stocks, technology, AI expectations, valuation, interest rates, and investor sentiment toward high-growth companies. The Nasdaq-100 also excludes financial companies, so it is not built like the S&P 500 or the total U.S. market. This does not make QQQ or QQQM bad, but investors need to understand what they own. QQQM is cheaper than QQQ, but it is not more diversified than QQQ. It is not automatically safer, and it does not solve concentration risk. Switching from QQQ to QQQM lowers cost, but it does not lower Nasdaq-100 concentration risk. That is why it helps to compare both of them with broader ETFs like VOO and VTI. QQQ and QQQM are often compared with broad market ETFs like VOO and VTI, but they are not the same type of tool. QQQ and QQQM track the Nasdaq-100. They are growth-heavy, they are more concentrated, and they are more exposed to large companies tied to technology and innovation. VOO tracks the S&P 500. That gives broader large-cap U.S. exposure. VTI is even broader because it covers the total U.S. stock market. So, for many investors, QQQM may work better as a satellite position than as the entire core portfolio. A cheaper Nasdaq-100 ETF is still not the same as a diversified total market ETF. This is important because someone may switch from QQQ to QQQM to save on fees, but still remain heavily concentrated in the same growth-heavy exposure. And in 2026, there is another wrinkle. Nasdaq-100 ETF fees are becoming more competitive. The Nasdaq-100 ETF market is becoming more competitive. For years, QQQ was the famous name. Then, QQQM gave long-term investors a cheaper Invesco version. Now more competitors are entering the space with lower fees. That matters because investors are becoming more fee-aware, and asset managers know that many long-term investors do not want to overpay for index exposure. So the real question in 2026 is not only QQQM versus QQQ, it is how much investors should pay for Nasdaq-100 exposure at all. QQQM is cheaper than QQQ, but investors may also compare other newer Nasdaq-100 ETF alternatives. The key is to compare more than the headline fee. Look at fee, liquidity, spread, tracking, fund size, structure, and broker availability. Lower cost matters, but the tool still has to work well for the way you invest. Now that we understand the cost difference, the use case difference, and the shared risks, let's pause for one quick reminder. This is the kind of no-hype ETF breakdown we focus on at Boring Money Wins. Not just saying the cheaper ETF is always better, not pretending liquidity does not matter, not ignoring taxes, and not confusing a lower expense ratio with lower risk. The goal is simple investing education without hype, panic, or unnecessary complexity. If this kind of breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now let's turn this into a practical decision. If you are looking at QQQ and QQQM today, what should you actually do? Here is a practical way to think about it. If you are starting fresh with new long-term money, QQQM often makes more sense than QQQ. You get very similar Nasdaq-100 exposure with a lower expense ratio. If you already own QQQ in a taxable account, do not rush. Check the tax impact before selling. The fee savings may not justify triggering a large capital gain. If you trade actively or use options, QQQ may still be the better tool. Its liquidity and options market can matter more than the small fee difference. And if your only goal is the lowest possible cost, compare newer Nasdaq-100 ETF alternatives too. The boring rule is this. For new long-term money, QQQM often makes more sense than QQQ. But for existing positions, trading, options, and taxes, the answer can change. So who may actually like QQQM? QQQM may appeal to long-term investors, especially investors who want Nasdaq-100 exposure with less fee drag. It may fit people who are making recurring contributions, people who do not trade actively, people who do not need options, and people who understand that the Nasdaq-100 is concentrated and growth-heavy. That last point is important. QQQM is not a magic ETF. It is not a total market fund. It is not automatically a safer version of QQQ. It is mainly a lower-cost way to access similar exposure. So QQQM may fit investors who know what Nasdaq-100 exposure is, want to hold it for the long term, and prefer to pay a slightly lower fee. That can be a very reasonable use case. But some investors should still be careful. Some investors should be careful with QQQM. If you think QQQM is safer than QQQ, that is wrong. It is cheaper, not safer. If you think the Nasdaq-100 is the same as the total U.S. market, that is also wrong. It is more concentrated. If you are ignoring mega-cap growth exposure, valuation risk, and tech concentration, you may be taking more risk than you realize. And if you are selling QQQ in a taxable account with a big gain just to save a tiny annual fee difference, you need to run the tax math first. Investors should also be careful if they are buying only because technology has performed well recently. Chasing performance is not a strategy. QQQM is cheaper than QQQ. It is not safer than QQQ. And that is the key idea before we reach the final verdict. So, should you switch from QQQ to QQQM in 2026? For new long-term buy and hold money, QQQM often makes sense. It gives very similar Nasdaq-100 exposure with a lower expense ratio. For active trading, options, institutions, or maximum liquidity, QQQ may still be the better tool. For taxable accounts, taxes may decide the answer before fees do. And for all investors, concentration risk remains the same. QQQM is cheaper, QQQ trades better, both still carry Nasdaq-100 risk. So the boring answer is not always switch or never switch. The boring answer is use the right tool for the right job. If you are investing long-term, QQQM deserves attention. If you are trading or using options, QQQ may still deserve its place. And if you are building a diversified core portfolio, remember that Nasdaq-100 exposure is not the same as owning the whole market. Boring money usually wins because boring money usually survives.